Welcome to Cattle Call here on the Nebraska Rural Radio Association. I'm Chad Moyer. Cattle Call is brought to you by Wolf Auto, small town strong. Check out their website, wolfauto.com. And joining us once again on Cattle Call today, it is Brad Kooima from Kooima Kooima Varilek at Sioux Center, Iowa. Brad, you and I, we've got a streak going, and it's I don't know if we're lucky or if we're good. Maybe it's a little bit of both. I don't know, but this cattle market just continues to move up and up and up. Just quickly summarize. We've got news for this week already, but again, what took us out of last week into this week?
Well, thanks for having me on first, Chad. And yeah, and it's always a lot more fun to report on a big bull market and higher prices, right? I'm sure that if hopefully neither one of us gets fired here too soon, because there'll be times when we're explaining why it's lower. But, you know, I think it starts with some of the same theme that we've talked about before, Chad, and that would be the incredibly strong cash market. And the cash market is much above the futures. We're actually, I think, talk a little bit more about that here later in your program. But that drag in this futures market higher because the cash market is so strong. And ultimately, to me, that still comes down to leverage. And it starts with the North, where we negotiate cattle. A lot higher percentage of cattle get negotiated up here than they do in the South. So when the numbers are tight here in the North, which they are, I've never seen them this tight. It forces the packer to come. And you know, there's not enough cattle to go around. I mean, that's sounds like kind of a trite way to say it, but the packer's slowing his kill down. Ironically, there's 2 new packing houses coming online. Their timing couldn't hardly be worse when there's a very big shortage of cattle already. But even with all that going on, hey, it's Mother's Day is around the corner, and grilling season and Father's Day and Memorial Day. We're going into this peak demand period here for meat. So they're going to have to harvest some animals here. And when you have leverage like this, it's fun. You know, last week we were, another $5 higher. I know there's bids getting passed here in my backyard that already would be $2 higher from last week. 225 has been bid and passed. There's been a couple of bids here. I was just talking to my partner, one of my partners here, that are even a little bit better than that, or just starting to develop here right while we speak during our program. So cash market's still very influential here. And even though we're very, very overbought, the market continues to grind on higher.
Yeah. Well, explain, if you would, expand on that just a little bit more, kind of where we are at with a capacity of kill. And then what you mentioned, the daily and weekly slaughter numbers are off just a little bit compared to a year ago. So tell me a little bit about that relationship and what's developing. What are you watching related to that right now?
I think that's a great question, Chad. I don't know. Hope everybody else thinks it's okay, because it's kind of it's for a numbers nerd guy like me, that those things are very important. For instance, last week's kill was 559,000. The week before it was 555,000. Okay. Now, you know, sentences that come to my mind when I see that is what is the available supply, right? I mean, what is that? Does that actually represent how many cattle we really have? I'm guessing, okay, but I would say it doesn't. I would guess that the available supply of cattle is probably 580 to 585, okay? So for a couple of weeks, and it's only been a couple of weeks, but for a couple of weeks, we maybe haven't killed the available supply, but I got to expand for just a minute on that. Part of that situation also implies or relates to the fact that we've pulled cattle forward because the weather was perfect through the winter. And we loved the price. Okay. The feeder did. He couldn't wait to sell into this deal because the cattle make a lot of money. So you sell cattle that are hardly fat. So, you know, you can probably compromise that a couple of weeks or maybe even a month or so if we don't kill the available supply, and still be maybe okay. But it's something that and the average weights are 2 things that I'm acutely interested in keeping an eye on here. It's May. As you get into June, there's probably a few more calves in the North. July, even a few more. August, a few. So, you know, as I look at it, you know, it's not going to be rainbows here every day. I mean, you know, if you're a hedger here and you're saying, well, is there a time here, Brad, where you're maybe dialed into thinking that, well, maybe we got to make sure that we've done our due diligence and did some good marketing. For me, it's July and August. But if something happens tomorrow, you know, plane flies into a building, who knows? I mean, there's that fear of the unknown. I think I said it to you last week and maybe the week before. Be smart here. Buy some puts, keep some protection on. Maybe stay with a little bit of optimism, but keep some puts underneath you. You don't want to do 2015 again.
Yep. All right. Brad, we've come to that part of the show now where we want to take some questions that have come in from our listeners and our viewers. And we're going to go ahead and start with the first one here. One question that came in from last week. How does the CME enforce cash settlement? And again, this is something where, when you have cattle in the pen and you're marketing cash like this, futures is, something a ways away from you, but the two do have to kind of come together. So let's take on that question first.
Well, it's a good question, and I think it's a good entry-level question for a lot of people because this is cattle call. So, right? I mean, we've got a live cattle futures and a feeder cattle futures, Chad. So the live cattle futures is still a deliverable contract, thank goodness, and it should always be forever and ever, in my opinion. The feeder cattle now is not. It's settled against a cash index. So when May feeders go off here the last Thursday of May, they'll go off, I mean, being offset. So if you've got a position on yet on the last Thursday of May, it's going to get offset based on whatever this feeder cattle index, which is index means average, an average price of feeder cattle that the index is 700 to an 899 pound steer. This gets interesting now. Cash, if they cannot have predominantly dairy, exotic, or Brahma cross. Now, you tell me how good that inspector's got to be able to tell whether it's predominantly dairy or not. Anyway, that's an aside. So they take all these average prices of these different regions of a 700 to an 899 pound steer. On Fridays, they factor in the country trade. So like if I buy cattle from a guy in Montana, private treaty, and they get reported, which they don't often get reported, but they should. That also goes into that index. Otherwise, they're at the Fort Pierre sale barn, they're at Erickson, they're at wherever else. There's a reporter there that's writing down this cattle that fit that. And then you take a 7-day average of that, Chad, of that index of all those regions, and you come up with the price. Every day it's reported, like today, it's going to be up over $2. It's going to be up at $295.79. So, there's people that calculate it right along with it. So that's how it's settled in the cash market against the feeder cattle index.
All right, very good. So that's very nice. And that gets us actually into a second question that is somewhat related to that. And so the next question explains what happens when the cash and the futures don't match up at the end of the month, because there have been times where there has been quite a discrepancy, right, between what's happening on the futures in Chicago and the mercantile versus what you just described going on in the country, right?
Absolutely, Chad. And it's almost become normal, to have this very wide basis. Basis is the difference between futures and cash. Okay, so what we're talking about is unusual basis, and that would be when cash is much above futures like it is now, right? And it was like that all the way through April. It was like that through the February contract. We could do a 3-hour show on this because, but we're not going to. Take a breath. To me, there's several factors. Okay, so nothing says that it has to converge when cash is above futures. If cash is below futures, you have a tendency to get better convergence, because then, let's say I've got cattle that are fat and I'm getting bid $2, but the futures are at $2.05. Well, I can sell futures and make delivery, and because that's a better bid. Well, everybody will do that. There'll be enough of that pressures that futures down to where you'd have convergence and they would be close to where the cash market is. But when it's the other way around, so I would like to see some changes made in the contract, because that would help it. Now, one thing that would be awesome is if they would add a demand feature. So in other words, if I was a packer, I'd say, well, why don't I buy June cattle futures at 212 right now instead of bidding 225 in the country, and I'll just wait until June and then I'll tell you to bring the cattle. That seems to me like it'd be a great idea, but I'm not the CFTC or the CME. But so that is kind of the weakness of the deal there. I mean, even the speculator that stays long and wants to take the cattle, he doesn't get them until the very last day. In fact, you won't get them until after the 4th of July if you stay until the end of the June contract. So it gets a little messy when the basis is over. Now, It's not a bad thing for the hedger. It's a great thing for the hedger. It's not a bad thing for the market really either, generally, because it has a tendency to keep us current. I think it drags the cash market down a little bit because at least the hedgers are becoming a little more willing seller than they might have otherwise. But convergence will happen when the futures are above cash. It hasn't happened. And I think because we also lack a long speculator, the guy that dares to step in front of it and be long at these high levels, is part of the problem with getting that futures to chase up to cash.
Yeah, I would imagine it's a unique situation. If you compare it to what folks do with corn, corn's not a perishable commodity, and you have to, these fat cattle, you have to deliver them at a certain time, right? You don't have to do that with corn and beans, right?
You're 100% right. That's what makes trading cattle interesting too, because it also, that example we talked about here 5 minutes ago, where are you 30 days ahead or you're 30 days behind? Think about that. That's 60 days, that's 15% of supply. If you do the math into 12 months, corn is corn. There it is. It's in the bin. It's the same yesterday, today. And, and it's non-perishable, like you just said. So it's, cattle are much more, for me, much more interesting, and trying to do the supply demand stuff. Corn's good too, but it's not the same.
I can tell the excitement in your voice that you do enjoy it. And thank you so much for all the questions from our listeners and viewers. And if you do have a question, something that's generated, hopefully this isn't going to be a 201 class or something like that. But nonetheless, put it in the comments and we'll see if we can talk about it in future shows. Before we run out of time, Brad, let's talk about what is going on this week. I mentioned at the beginning of the program, we've already seen some trade develop here this week as we're recording this on Thursday, middle of the morning. What are the factors in play for this week's cash cattle market?
Well, it looks like we've got, I think you're going to have, I thought last week the Packers seemed to try to get a little more inventory around him. So I don't, this putting on $5 a week like we did 2 or 3 weeks in a row here, I don't think that's in the cards, but I do think we are going to be a little bit higher. The show list in the north, especially tight. Nebraska and Iowa, very, very, very current, and just a total lack of, just a real difficult lack of supply. South will probably lag for a couple of reasons. They've got a few more cattle than we do, and I would say we're still looking at a cattle that'll grade just a little better here in the north. So I'm going to say cash is going to trade somewhere around 26 or 27 in the north, and maybe towards 220 in the south, and I think that spread's going to widen even further from north to south.
All right. Quickly remind us your contact information. More, how can we talk to you about what's going on in the cattle markets these days?
Well, you can find a little bit about us on our website, kkvtrading.com, but the best place, I guess, is our number, 712-722-0023.
All right, Brad, it's good to talk to you. Talk to you next week, okay?
Sounds good. Thank you.
Again, that's Brad Kooima, Kooima and Varilek in Sioux Center, Iowa, and this week's Cattle Call. Again, the Cattle Call is brought to you by Wolf Auto, small town strong. The Nebraska Rural Radio Association thanks you for being on this week's program, and we'll see you next week.